Gold down about 2% again this morning. Again, crowded trade. It is having its first sharp pullback within this uptrend. And it came down, hit the 20-day, had a little bounce, and now it's coming down. If we were to just zoom in on this, you can see this is a high momentum move because of gold. It's had this momentum move to the upside. If we were to just take a look at where Fibonacci is telling it could potentially go here, that is down to about 3,800, 3,795. So this could continue to unwind a little bit more and really shake things out. That would be a full A, B, C correction. And as you know, it's the C correction that breaks this low right here. This is where we start to get people panicking and flushing out and bailing, and that's also what can create that next move to the 100% target. And then from there, we could see potentially a knee-jerk reaction and start to see gold have a much bigger move going forward if this is that big blow-off phase to the upside. And the market's had a very strong close when it comes to the large tech and the Nasdaq, pretty much powered by the Magnificent Seven. We talked about this morning in the video, saying, hey, whatever way the Magnificent Seven breaks and runs, it's going to drag the major markets. And today we had a big pop in the Mag 7, moving up about 1.3%. And of course, this afternoon we saw Nvidia really get juiced up, rallying about almost 5% to the upside, creating a pretty big move. Now, this has been really nice for the Nasdaq. If we take a look at the QLD, a recent position we put on with our band strategy has just taken off. It actually hit our first 6% target in only a few days. So that was a nice little push. Now this momentum will likely carry over to tomorrow. The price action on the charts, though, let's pull up the QQQ. I'm not a huge fan of this type of price action on the charts. People are piling in. We have more so interest rate kind of driven momentum. This is kind of buy the rumor, sell the news. So we have one gap here. We have another large price gap here. We have another price gap over here. As we know, gaps on the major indices tend to get filled. Now, that doesn't mean they have to get filled right away, although they generally do. So we do have 3 of them here.
While the momentum surged, the charts told a more cautious tale. Multiple price gaps remain unfilled, classic zones where markets often retreat to revisit. The QQQ itself showed signs of crowding. Late buyers piling in, momentum chasing interest rate narratives. That buy the rumor, sell the news tension looms. Meanwhile, the equal weight S&P and small cap indexes have failed to confirm strength, stalling or pulling back. In short, under the surface, participation is narrow, and divergences suggest this rally may require a pause or correction to reestablish confidence.
And people are chasing, I think, the interest rate cut. And we saw this previously. We saw rates run up with interest rates, especially with the bond market. Actually, let's go take a look at TLT. The last time we saw the rates starting to move up, we saw the market just running gap higher. And now that we've seen rates start to actually go down, now I think people are moving over to equities, saying, hey, if rates are going to get cut again, that means people who are saving are going to move from savings accounts and things like that to the equities markets. And of course, equities this time are having that big pop. Now, again, it's a little convoluted because we're looking at the QQQ. The Magnificent Seven are doing a lot of the heavy lifting. If we actually take a look at, let's look at kind of the equal weighted overall broad market as a whole. This is equal weighted S&P 500, the small caps, the Russell 2000, and the micro caps. You can see they're actually kind of just poking up to these highs and pulling back. They actually moved down a little bit. So it wasn't a full broad market rally. And again, you can see that just looking at the IWC here. If we look at the IWC and the IWM, these are small caps and the micro caps. They're not really pushing up higher. So again, a magnificent run, pardon the pun, higher today. Now, if we take a look at gold, we're talking about how it was a crowded play. We ended up hitting our key target right over here with our gold trade, and we moved aside because our target had been hit on one of our discretionary bonus trades. We just got in over here and we rode it up for 15% move, got away from it.
Turning to hard assets, gold again commanded attention. After a recent swing trade hit a 15% objective, that position was closed, even while long-term gold holdings remain in place. The precious metal space is balancing between participant overextensions and underlying strength. Silver miners are stepping into accumulation zones, while gold miners show classic Sell the panic, buy the dip signatures. Analysts now debate whether this pullback is healthy consolidation or a deeper reversal, especially in light of 2025's earlier 150% gains across several mining indices.
Long term, I still do hold all my physical gold and silver. I will be potentially looking to get rid of it if gold starts to show signs that it's put in a major top. I do believe gold is going to go higher, but I know, everyone has, a lot of people have been piling in this phase, and this is when I was pounding on the table saying, don't chase things just because you have FOMO. Like, let it get a bit of a breather here. And now we've got that breather. We've got an A, B, C correction. The C correction, as I mentioned this morning, this is where usually the market starts to flush out because people say, oh, it's broken a pivot low. There's also a low right across here. It's broken both of those. And that's enough to start to spook the market out. Now, we had rising volume as people got FOMO and money was piling into the precious metal space. We do have, it's still elevated volume, but it's definitely lower. It's not like we have massive spikes in selling volume here when it comes to gold. So it's really just, I think, an unwinding of position. This looks fairly controlled still. And overall, I do think eventually it's going to stabilize and potentially head on up to a much higher price. So anybody who's underwater right now or trapped in a gold position simply means you literally bought with the FOMO fury of like this last wave where I said you could cut the air with a knife, and that's usually not the phase you want to jump in. You want to let some of the air out of the balloon here before kind of regrouping and letting it shake itself out before stabilizing and going higher. Now, if we take a look at miners, let's just out of curiosity, let's actually go take a look at silver miners, SILJ. They posted some decent gains today, hitting the 50-day moving average, trying to find some support. If we look at the small cap gold stocks, the GDXJ, very similar, gap lower, is starting to get bought back up. And this is the sign that it's kind of back in accumulation phase. You can see these big red volume days on the chart. They are panic selling days, people bailing out. And what we're seeing now is the market is gapping lower, and then it's getting bought back up. So these gaps to the downside, people dump their shares at the open because they get scared, but there's actually people out there accumulating, saying, okay, like a bunch of the air has been let out of the bag here.
One of the more revealing patterns, dividend-paying blue chips have lagged badly. The SP ETF, thought to embody steady, income-oriented leadership, saw selling even as large growth names lurched higher. Small and micro caps likewise failed to join the party. This internal weakness signals that this rally lacks broad support. The money seems concentrated in a few momentum engines. Traditional, safe, yield-oriented equities are being ignored, which raises red flags about sustainability, mass appeal, and what happens when sentiment flips.
And now, or the balloon, and now whenever there's bouts of selling, there's people stepping up, just accumulating, sucking those shares in. Same thing happened this morning. The market opened lower, and then it got bought back up. So this is a good sign. The volume days, the down volume days are high volume. The up volume days are still kind of sort themselves out. But these are usually signs that the downward momentum is stalling and it's starting to neutralize. Another interesting angle to look at the markets is the SPYD ETF. Now, this is the high dividend ETF for the S&P 500. This is obviously what most investors, long-term investors, when they invest in blue chips and they want dividend income. Interesting enough today, again, the stock market pushes to all-time highs. And of course, long-term investors take it on the chin. They lose over 1% while the market's moving higher. Dividend stocks have really been struggling. If we zoom way back here, they're nowhere near the highs. They've been going down all year. Again, that's not the greatest sign. It's interesting. We do have a ton of volume in this ETF. I'm not sure what's going on there, but there's definitely a lot of volume in that space. I think maybe dividend investors are getting nervous or they're piling in. I don't really know. But again, it's interesting that the market today, large cap dividend stocks sold off. And we also saw the small caps and the micro caps selling off. So again, the market isn't that strong. When we look at the market sentiment overall, the money flows here, we can see that we had this previous point. We just had this massive bout of a lot of money moving out of the equities markets and looking for protection and defensive plays. It's really hard to see here, but we have had these bars turn green and it's extending to the upside. But again, there's a lot of weakness under this market. We'll just have to see how this unfolds. And we got to ride these trends if they continue to go up. You do need to be long this market. You can't just sit on the sidelines just because we're worried the market is going to fall over. The key is to identify when to be in, when to not to be in, and go from there.
A central theme underpinning these moves: interest rates and bond markets. When yields began to roll lower, equity flows followed as capital exited savings and defensive instruments. The flip side is clear. If yields re-accelerate, this fragile equity rally may crack. Meanwhile, gold and silver are tethered to rate expectations too. Citi, for instance, recently warned gold could fall below 3,000 autzins in a scenario of reduced safe haven demand. The interplay of central bank messaging, inflation surprises, and bond flows now sits squarely at the heart of what comes next.
Gold down about 2% again this morning. Again, crowded trade. It is having its first sharp pullback within this uptrend. And it came down, hit the 20-day, had a little bounce, and now it's coming down. If we were to just zoom in on this, you can see this is a high momentum move because of gold. It's had this momentum move to the upside. If we were to just take a look at where Fibonacci is telling it could potentially go here, that is down to about 3,800, 3,795. So this could continue to unwind a little bit more and really shake things out. That would be a full A, B, C correction. And as you know, it's the C correction that breaks this low right here. This is where we start to get people panicking and flushing out and bailing, and that's also what can create that next move to the 100% target. And then from there, we could see potentially a knee-jerk reaction and start to see gold have a much bigger move going forward if this is that big blow-off phase to the upside. Now, if we take a look over at silver, it's down about 0.6%. Again, it's had a couple waves to the downside. We've had a little bit of a pullback right here. We got pullback, pause, and it's pulling back. It has sold off quite a bit in early morning, but it has recovered so pretty much all of that move. So it did have a little bit of a flush out this morning. Again, silver is going to be pretty volatile. And if we look at gold miners, actually, let's go to the hot list for gold miners. Gold miners are down near the bottom of the list here. They were at the top of the list, and now they're down at the bottom. And PBW, which was at the bottom of the list a few days ago, is now at the top. And this is what happens usually in a stage 3 topping phase. Sectors are hot, and then they roll over and die, and they go to the bottom of the list. They flip and they flop. And this is sector rotation. People just keep chasing where the money is, and it becomes more and more volatile. And of course, we've definitely seen that in the mining space. We've seen miners have quite the pullback from the high down to the low.
Looking ahead, the most plausible scenario is for this rally to pause, consolidate, or correct before resuming if earnings and macro trends remain supportive. The narrowness of leadership, coupled with overextended momentum, raises risk of abrupt sell-offs. In metals, a transitional base may form before the next leg up. For equities, the discipline will be in identifying when to lean in and when to step aside. Be alert to tipping points, yield reversals, earnings surprises, or breadth breakdowns. Ride momentum, but don't become hostage to it.
I grab this tool, high down to the low, roughly about 20% pullback in the blink of an eye. And just goes to show, it's very easy to give back gains and if you're not managing positions. And this is just the first pullback. Eventually, when this market does stall out, we will probably see, miners pull back 30, 40, 50, 60% when we do go into a correction, something pretty substantial. So this is just typical price action within a strong momentum wave. You do need to give things about 20% wiggle room for stops to let it breathe as it works its way up these high momentum moves. Taking a quick look at Bitcoin, not a whole lot going on here. Grand scheme of things, it got oversold, kind of hit this 150-day moving average. It's had a bounce, but in the grand scheme of things, it's really just trading through resistance, coming up into a mid-range. Not a lot of excitement in this space. Again, it's got a series of higher highs, a series of lower lows. It's called a megaphone pattern. It's just getting uglier and uglier and more unpredictable as it unfolds. So best to just steer clear of it. And it's somewhat in the middle of no man's land here going forward. If we take a look over at energies real quick, Let's take a look over at crude oil, down 1.35%. It had that bounce within the market. We saw it bounce, and it came down into a critical support level, which was down here back in April and May. We talked about how this is a very critical level. It's got a strong bounce. Yesterday and the previous session, we talked about how it's in a downtrend on our 30-minute chart. Red bars, it got into overbought territory. This red shaded tells us it's overbought. It's moved too quick, too much and too quick to the upside on a short period of time, and usually that's when sellers come in and we're starting to see it sell off. And today it is set to be down around 60.40, which is back down to the 100 or the 20-day moving average. So it's kind of unwinding and fizzling back out. And last but not least, if we were to just take a look at the 2007 market top, where gold had its, right as the stock market was starting to show a little bit of weakness, which you could argue we might be seeing a little bit of weakness with a down week here, but this is where gold had its first significant pullback and consolidation. The yellow line, if we pull forward, gold traded sideways here, and then it shot higher for a final big move. I feel like that could be right about where we're at. Gold could chop sideways here for a couple of weeks and then have a big shot higher and rally as potentially the stock market rolls over. But right now the stock market is still on fire. The Magnificent Seven, the AI, the innovation phase is dragging this market higher. But I do think we're going to see the precious metal space find some traction here after this first bout of people who all chased into precious metals in the last week or two. They're just getting shaken out and spooked out here, the momentum traders, before I think we see another big push. This big run up here in gold is when the stock market starts to struggle and starts to pull back. All the money will move away from equities, and it'll want to plop itself into precious metals and miners going forward. So that's what we're looking at. But again, until the stock indices actually roll over, if they're in an uptrend, we want to be back. We want to be long these equities going forward.